Hi, I'm Mary Kopczynski, the CEO of RegAlytics, with your update on this week's 32,143 regulatory alerts. The regulator of the week this week is the United States of America, where bills season is coming to a close and moving into the next phase of being passed. And specifically, I'm going to call it the week of the red states of America. Starting with Arkansas, which banned non-competes for certain medical professionals. Speaking of medical professionals, Idaho has now prohibited the entire state from mandating the use of medical face masks to prevent the spread of contagious diseases. Let's hope that doesn't backfire on them later. South Dakota has prohibited healthcare professionals from performing medical procedures that alter the gender or validate gender perception that is inconsistent with a minor's biological sex. Wyoming has banned DEI programs by the Wyoming government. However, interestingly, when you read the bill, it says you can't give preferential or differential treatment, and you cannot treat race, color, religion, sex, ethnicity, or national origin as inferior or superior. They've also excluded tribal members and governments from any of these definitions. Finally, Wyoming mandated that the Wyoming Livestock Board create a notification protocol for anthrax outbreaks following animals that test positive for anthrax. I wonder what the backstory is there. The topic of the week is banking regulations. I know, it's been a while. Many of you are used to me getting deep into the weeds on financial services regulation, and I try to avoid and focus on other things because there's so many other things. But this week has some really good ones. Starting with Nebraska, which amended various sections of its banking and finance statutes with the intent to modernize them. But the first order of federal business is the Financial Services Committee of the U.S. House of Representatives. So they completed their first full committee markup, which means they went through all of the proposed bills and gave their recommendations of what they thought should pass and what needed to be tweaked. So one of these is a Consumer Financial Protection Bureau rule that was finalized in December. It targets very large financial institutions, and it caps overdraft fees at $5 effective October of this year. So what does this mean? Well, some of you may have experienced in your life where you've accidentally taken out more from a bank account than was there. And some of you may even have had the terrible misfortune of having this happen, being unaware of it, and then withdrawing another amount, erroneously believing that money was there, when in fact, a series of overdraft fees have been charged, putting the account in a much more negative state than you realize, creating a vicious cycle that can add up very quickly. So, the FDIC passed this rule, and no surprise, the banks hate it. And of course, no surprise, they are lobbying Congress as hard as they can to treat this as a Biden-era rule that must be reversed. But what's really interesting about it is the language. It's known that overdraft fees hurt those with the least amount of money. But the argument that they're making to overturn it is because limiting overdraft fees is actually hurting low-income customers who rely on overdraft capabilities. I'm not going to get to the merits on this, but I do find it a really interesting topic of what helps low-income people, and I wish the language wasn't so loaded. Meanwhile, the FTC, Federal Trade Commission, came out with a report on fraud in 2024, and it jumped up by 25%. That is $12.4 billion in losses last year due to fraud. The OCC has clarified that various cryptocurrencies are officially allowed within the federal banking system, just like that. The OCC has removed the previous requirement for banks to obtain supervisory non-objection before engaging in these activities. The chairman The U.S. Senate Committee on Banking, Housing, and Urban Affairs, Tim Scott, has introduced the Financial Integrity and Regulation Management Act, the FIRM Act. The purpose is to eliminate reputational risk as a reason for banks to reject customers. What does this mean? Well, this is in response to banks that, for example, stopped accepting deposits from fossil fuel focused companies, okay? The claim is that it will restore the bank's autonomy in decision making. But I'm not totally clear on how this provides the so-called autonomy that banks are craving, because as I read it, it means the bank pretty much has to take somebody's money if they have it, even if the money they have is made through controversial ways that the bank itself doesn't want to be associated with. And it just wouldn't be a day if we didn't mention something about what's going on with the Trump administration and DOGE. Interestingly, the U.S. Senate Committee on Environmental and Public Works, certainly not a regulator everyone associates with banking, just sent a public letter to Jane Fraser, the CEO of Citibank, asking her to detail the freezing bank accounts which hold greenhouse gas reduction funds. These funds contain legally obligated federal funds that were appropriated in the Inflation Reduction Act that are aimed at powering domestic investment in low-cost clean energy and energy in general. The Democratic senators behind this are now getting the banks involved in the legal disputes around DOGE, which means we can continue to be certain of one thing: litigation, litigation, and more litigation. And that's it this week for RegAlytics. We have the global supply chain of the world's regulatory alerts in one very easy to use place. If you need a solution for anything related to regulation, give us a call.